It could be a mistake to believe that buying a new business is a better idea than holding on to a great business. And I definitely believe that the sure way to succeed is by limiting your transaction costs, limiting your taxes, limiting your fees, limiting your trading. The only way, I believe, for you to get really wealthy as an investor is either through private equity, meaning owning your own business or investing in a small private company that just goes crazy, or through public equity by compounding over time. It's really hard to beat someone who's owned Coke stock for 30 years because every single year that capital is compounding at 50 to 70% because of dividend payments. And the dividend payments increase every year. You only get to that situation, though, if you're willing to hold the stock for 20 or more years. So anyways, what I wanted to build for you was a portfolio that you could operate just like the Leaders Trust. I wanted to build a portfolio that you can just literally set aside, never look at again, and let it compound. Let's say you want to leave $1 million to your grandchildren or your great-grandchildren, and you don't want the trust company to screw it up. You can buy this portfolio, you can set it to be a gift to them in 30 years, and you can walk away. So the portfolio that we're going to reveal to you today is my optimized version of that idea. And if you look at just using the ETFs, which we talked about in the journal the past week or so, so these are just really simple ETFs. This isn't a fully optimized portfolio. It's just basically making one important change, which is substituting the bond portfolio in Harry Brown's portfolio with insurance stocks. So instead of 25% in bonds, you've got 25% in insurance stocks. And why insurance stocks? Well, insurance stocks because they own big piles of bonds. They're bond managers. And then instead of owning the S&P 500, we used a simple quality and growth screen. So we used the quality ETF made by iShares. Just an algorithmic way of picking stocks that have high margins, high moats, and growth. That's all we did. Those are the only changes we made. And just making those changes, we were able to increase the annualized return by about 30%. And as you can see over time, that's going to produce much better results because your capital is compounding further. One other change we suggested is if you can stand a little bit more volatility, because the quarter version of the permanent portfolio still is only about half as volatile as the overall market. So if you take out all of the cash and you double the position in insurance stocks, so you're 50% in insurance stocks, you're 25% in high-quality corporate equities, and you're 25% in cash and Bitcoin. If you do that, then you're going to have a 13% annualized return, and you're still going to have less risks in the stock market, which is really a really beautiful portfolio.
There's a reason why the world's best informed investors read my daily journal. Subscribe for free at portersjournal.com.